Ticker symbol PM is up around 45% in the past year. And today we'll be looking at a wide moat company with great free cash flow management, which also pays a hefty dividend. This company offers consistent growth, with its net income growing over 27% in the past year. Additionally, it has faced consecutive quarters with net margin expansion. So today we'll be looking at Philip Morris, a tobacco company. In their annual report, they state that they're the leading tobacco company which is actively evolving their product portfolio for the long term in order to include products outside of the tobacco and nicotine sector. I'm sure we all know what Philip Morris does. We've all seen their products, and we all know someone who smokes. One thing that I did find extremely interesting from their annual report is that immediately they go against smoking. As we all know, this industry is heavily regulated due to the harm that it causes to your health, which even makes their annual reports seem like an apology letter. For example, look at this quote. "We believe regulation must include measures designed to prevent youth initiation." So the company that sells tobacco products, in their annual report, is stating that they believe that the government should implement measures in order to keep the youth away from smoking. So they know that their products do a lot of harm to people, and they know that they should probably stop selling these. However, they just bring in so much money that they have to keep operating. Their current product portfolio consists of cigarettes and recently included smoke-free products. Over here you can see in the picture IQOS, which is their biggest success. It's basically like a cigarette, but you're not burning the tobacco, so it's less harmful to your health. Plus, they've managed to give this product some sort of a luxury appearance, which has improved its market penetration in all markets. They say that their cigarettes are sold in 175 markets, which is almost the entire world, and in many of these markets, they obviously hold the number 1 or 2 market share position, because Philip Morris is the clear market leader in this industry. Now, IQOS is only available in 84 markets, but because this product has started its expansion phase. It's very recent, and people are embracing it with a lot of enthusiasm. And when we look at their financial analysis, it is clear that this company is a monster. They have a return on capital employed of 31%, which is incredible. Just for you to put this into context, we usually look for companies with a return on capital employed above 15%. Now, their interest coverage ratio does seem low with a 6 times interest coverage ratio, where we usually look for companies with a 10 times or above. They have a very solid 86% cash conversion, an incredible 64% profit margin, and they're highly profitable as they have a 26% operating margin. Now, in the past, this company had a period of very stagnant revenues because they have been doing the same thing for a very long time. Over the years, the volume of cigarettes shipped has actually declined. However, they have been overcompensating this with price hikes, and since people are addicted to smoking, they are forced to actually keep buying the product even if there are price hikes. And now recently, thanks to their IQOS expansion and their price hikes, their revenue has been increasing for the past quarters. We can also see that their net margin has started to improve from the lows it hit in December 2023. And now, accordingly, their efficiency ratios have started to recover. Now, one thing that I did not like from this company is their balance sheet. This is because their total liabilities are actually above their total assets, which implies that this company has negative equity. This is usually a big red flag for any company that has it. However, Philip Morris has been having negative equity for the past 10 years. So, although you should investigate further into what is actually causing this, it looks like it's nothing that should be too scary for this company. Now, when we look at their fundamental analysis, this company gets a solid 4.5 out of 8. But because I've been very strict with the analysis, first of all, they have extremely consistent cash flows, and they're able to grow their revenue organically. And organically basically means that they don't need to rely on M&A. They did in the past. Now, thanks to their newly developed products and their strategy of moving away from the traditional cigarettes, is actually allowing them to increase their revenue in an organic fashion. Now, Philip Morris is extremely famous for the dividend that they pay, as they have a very high dividend yield and they're a consistent dividend increaser. But the two most important things from this slide, I believe it's the pricing power and the competitive advantage that this company holds. Now, the pricing power is very easy to figure out. To me, this is basically defined as being able to increase your prices without losing so many customers, to the point where it actually makes sense for the company to increase their prices as the overall revenues will increase. Any cigarette company, of course, has this, because most smokers are addicted, meaning that regardless of any pricing increases that these companies actually conduct over the years, they will have to keep buying this. and this has been the case ever since these companies started selling their products. The one counter argument that I would have over here is that this industry is so heavily regulated that I believe that in most years, taxes on these products are also increasing, which to a certain extent limits their pricing power because they also have to account for these increasing taxes and for their heavily regulated environment. Now, secondly, this company has one of the largest existing moats you can have because they're the leading company when it comes to cigarettes. They're developing one of the most innovative alternatives to this sector, and it is extremely hard for any other company to actually come in because what they have developed right now with IQOS is a product that only works with cigarettes that Philip Morris itself is selling. Previously, you could just go to a shop, buy whichever packet of cigarettes you wanted, and you could smoke a cigarette from whichever company you could. Now, you buy your specific machine, which in most cases will be IQOS. From then on, you can only purchase IQOS cigarettes because they only work with that machine. So they've created an even larger competitive advantage than the one they previously had. However, there are a lot of things that I don't like about this company, such as them having a 6 times interest coverage ratio. Even though their earnings are very consistent, I would like them to improve their debt position. Next, I have to include that they don't have a solid balance sheet due to the negative equity. However, they've been having this for such a long time that it may not be an issue. Now, number 3 is that they don't conduct share buybacks, and from year to year, shares are actually increasing at a very small percentage. And finally, their free cash flow is not growing organically yet. Even though their revenue is growing, this is not being translated into free cash flow yet. Now, when we look at their dividends, this company holds a 4% dividend yield, even though the company's price has increased by 43% over the year. Now, one thing that I'm not too happy about is that their payout ratio is an 83%, meaning that around 83% of their net income or of their free cash flow is paid out in dividends and cannot be used for anything else. This number being so high is kind of scary because it basically limits their ability to keep increasing their dividends forever. Now, when it comes to valuation, this company is currently trading at the highest it has been trading in the past years. However, when we look at free cash flow yield, we can see that it's currently trading at around 5%. When comparing to the 3% long-term inflation rate, this company may actually seem undervalued from this point of view. Now, when we look at risks and possible challenges, the main risk that I see is, of course, regulatory risk. The way they're starting to regulate this is to ban the sale of these products to younger generations. This is done in order to not limit the sale of these products to people that are already hooked or addicted to these products, but to stop this from becoming an issue in the long term. Now, before we move on, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, this company has one of the best moats there are in the market. It provides consistent cash flows which are extremely predictable, and it has high return on capital employed, meaning that it knows exactly how to create value for the investor. So I believe that this is a good company and it may be a good investment. However, this company holds high regulatory risk. Anyways, thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and I'll see you in the next one.